Hello and welcome everyone to our weekly crypto journey session. Thank you so much for tuning in. We are hosting this talk every Thursday during your lunch hour, so you can join our crypto talk while you're having your lunch. First, let me introduce myself to some of the new faces here. I'm Merlinda, one of the awesome member of Team Dasset, and I will be your moderator for our weekly crypto journey talk. Each week, we will be doing a presentation for our chosen topic for the week, followed by a hands-on demo so that you can get better and navigate the world around crypto. And before I introduce our speaker for today, I wanted to let you know if you missed any part of the crypto talk or would like to hear this session again, there will be an available recorded version by request. Also, we would love to hear from you. So feel free to post a question or an opinion just by clicking on the Q&A box below, or even chat alongside the screen and we will be able to get there. For today's session, we have our very own Dasset CEO, Stephen McCaskill. And without giving too much away for today's topic, we'll be diving deeper into the history of money and getting to the heart of the question, why Bitcoin? So let me just hand this over to you, Stephen.
Thank you so much, Merlinda, and thank you everyone for being here. I'm really excited to talk to you about this topic because this is really what got me into Bitcoin. My background is in monetary theory and monetary history. And before I was in Bitcoin, I ran a precious metals company. And we used to sell gold, silver, bullion. And part of the reason why is because of its long history with money. Now, this is a very complex topic, and so I'm only doing it at a very high level. There's so many different rabbit holes that we can go down, and so I'm going to try and keep it as simple as possible. But really, I think there's a lot of misunderstanding behind what is money, what it's used for, and we usually have a really bad relationship with money, and there are a number of reasons why. And so before I begin, I do want to start by saying that Bitcoin, I don't believe that Bitcoin is money at the moment. You know, that's not the argument I'm trying to make. I don't think that Bitcoin is money. However, I do think that Bitcoin has the potential to become money, and we'll go into that. So before I start, I run Dasset. Dasset is New Zealand's trading platform for digital assets. We have over 80 different digital assets trading on our platform, and we cater to institutional customers, high net worths, and professional traders. So when we look at money, you know, a lot of different things come to mind. And I think it's really important to understand its history and what it's meant to do to really understand where it's going in the future. And so, you know, when we first look at money, I think what we need to realize is that over history, there have been many different things that have been used as money. And how that materializes really depends on that time and place. So a few hundred years ago, there was a gold rush down to the South Island to an area, a mountain called Mount Aurora. And the first people who got there were led by Maori guides. And once they got to the river, they found millions upon millions of dollars in gold just sitting on the river banks. And within a day, the two people the two Westerners who got there first managed to pick up $1 million in gold off the ground with very little effort. It's very similar to the crypto rush that we're seeing today. And when they looked at all this gold just sitting there, they turned to the Maori and asked, why did you just leave this here? And the reason why was because the Maori really had no use for gold here in New Zealand. And so, what was used as money in New Zealand was jade or greenstone. And so what we see is that value is really in the eye of the beholder. And there are many different things that are required for us to see value in something. And so jade was something that was very precious here in New Zealand. But in other parts of the world and throughout time, for most of human history, that form of money tended to be gold and silver. So it really, money has the potential to evolve over time into different things, and because it really comes down to what we perceive as valuable and how we utilize it. And so if it's not useful, then it's not necessarily going to be used as a form of money. And so, so that's why something that was money 50, 60, 100 years ago isn't necessarily money today. And so when we look at these definitions, this is actually a definition that I've come up with thinking about money over the last 15 years. And when we look at what money is, what I like to equate it to is something called a spontaneous order. And so it's really a technology that emerges over time. And another example that it can relate to is the English language, or language in general. So a language is also a spontaneous order. It's a technology, it's a protocol that serves a specific function or serves a specific use, enables us to communicate with each other. Money is pretty much the same thing. Money is a language that helps us communicate information. And usually that information that is communicated is scarcity. So, and that's really embedded in things like prices. So we don't have to know that there is a drought for a certain commodity on the other side of the planet. What we can do is go to the grocery store and we see that the price of something is higher. And based on that higher price, we make the decision to buy that or buy a substitute. So we don't have to know why a price moves. What is embedded in the price is information about all the market participants in the market. And so what money helps us do is identify scarcity and make decisions based on that. And so I like to, so I've kind of expanded the definition of money a little bit, where we have a universally accepted language of value, and that is something like our monetary system today, where we use New Zealand dollars. It's universally accepted within New Zealand and has certain features. Now, I've expanded the definition of money to include or to add sound money. Now, sound money is a universally accepted language of value, is bound by the laws of nature. And I bring this in because I think the money that we have today is not sound. And part of the reason why is it's not bound by the laws of nature. It's not bound by physics. It's not bound by essentially factors that we cannot control. And therefore, it loses some of its ability or usefulness as money. And so when we look at money, the key features are medium of exchange, unit of account, and storage of wealth. And particularly, I think that the storage of wealth aspect of money is lost when we move away from sound money and towards monetary systems that we have today. So when we look at the history of money, we see that for most of human history, money has tended to be silver. A lot of people think that it was gold. But if we look at money over the last 3,000 years, although there were many different things that have been used as money, from furs to shells to tobacco to different commodities, most of civilization has developed on the back of silver as money. And we can look at our forms of money today to see the roots. So the term dollar is actually a representation of a specific amount of silver, or that's what it used to be. So the dollar came from a silver coin called the thaler, which was known to have a very specific amount or weight of silver. When we look at the British pound, what it really is a pound of sterling silver. So that's why it's called the British pound sterling, because the British currency was a specific weight or unit of silver. And the big reason why are the physical properties behind precious metals. So gold, silver, copper have tended to be used as money throughout history because of the properties embedded in those metals. And some of those properties are superficial. For example, shiny. We as humans love shiny objects. We like to chase shiny objects. And so more than 50% of gold is used as jewelry today. And there's a reason why, and that is in its beauty. And that's where we see that value is very subjective. It really comes down to what we find beautiful. But it goes a little bit beyond that. When we look at the properties, silver and gold are the best conductors of heat and therefore electricity. And this is why you'll find gold in almost every cell phone in the world. You'll find silver has a lot of medical properties. So it's used heavily in hospitals and dentistry and just a variety of different industries, specifically electronics, because of their underlying properties. So in addition to that, it's malleable. When we look at gold, gold doesn't corrode. And so all the gold that has, when we look at the gold supply today, it includes all the gold mined since the beginning of time. And that makes it a very unique asset or commodity compared to almost everything else in existence on our planet. When we extract resources from the earth, a lot of those resources get used, and with the exception of a few of them, and gold is one of them, where it does not corrode. And so we don't use it up. Silver, on the other hand, is a little bit different because it is something that corrodes and gets used. But interestingly, what's, over time, as silver was money, what happened was a mistake. So we essentially transitioned from silver as money and recognized globally as the form of money to gold. And it was primarily because of a physicist who made a mistake and essentially undervalued silver and overvalued gold. And that was the mistake of Isaac Newton. So Isaac Newton was put in charge of the Royal Mint in the United Kingdom. And when he was in charge of the Royal Mint at the time, silver was the currency of choice within Europe and essentially most places in the world. But what Isaac Newton made a mistake was setting a government mandate to set a specific conversion rate between gold and silver. So the British Treasury would essentially redeem a certain quantity of gold for a certain quantity of silver, and that rate was never adjusted. So rather than relying on market prices and the market rate, it was a rate that was set by a central authority, specifically set by Isaac Newton. And so and this was in the 1600s, 1700s. And so essentially what he ended up doing was underpricing silver. And a big reason why was the discovery of the New World. With the discovery of the Americas, countries like Italy, Spain, Portugal, and France started finding huge gold reserves in the Americas. And they hauled their gold back to Europe, and they converted their gold with the British government for silver. So because Isaac Newton had undervalued silver, the other governments within Europe were quite happy to exchange their gold, their overvalued gold, for undervalued silver. So the British Treasury started losing its silver reserves. So the British government essentially lost all of its silver because it was redistributed to other countries in Europe. And so this forced the British government to change its policy and transition from silver to gold as a form of currency. This happened in the US as well. So the US government, after forming in the late 1700s, set a very similar policy where they essentially honored the conversion of silver to gold at a very specific rate. And this essentially enabled the transition of our global monetary system from silver as a recognized form of money to gold. Now, pretty much every country in the world over that 200-year period transitioned their monetary systems from gold to silver, with the exception of a few, and one of them was China. Now, during this time, we started to see a new invention or innovation in money, and that came down to paper money. Now, paper money had been tried and tested in China, and that's where we know as the kind of the original innovators behind the transition in money. However, that ended up in a lot of failures. I believe they, in China, they attempted maybe 10 to 15 times different monetary systems, and I think pretty much all of them failed. And so, China's history of money is very solid. They have basically learned a lot from their mistakes over the last 2,000 years of experimenting with money. And so there's a lot to be learned about our monetary systems when we look at different countries and how they've utilized it. But our paper monetary system today came specifically from the 1600s, and primarily in Northern America, in Massachusetts. So Massachusetts would pay soldiers to go into Canada, what is now known as Canada, to essentially steal from the French and local Native Americans to bring back loot and sell in Boston. So they would essentially pay soldiers to be pirates, to attack their enemies and bring back goods. So at one point, the Massachusetts government did not have money to pay these soldiers. And so what they decided to do was create pieces of paper that represented metal, and created 40,000 units of paper that, and they made it on the back of two promises. The first promise was that the paper would be redeemable for metal in the next 2 years. And the second promise was that they would never print money, paper money again. Now, as these things go, and as you can guess, both promises were broken. A year later, the the Massachusetts government decided to double the amount of paper in circulation. So they printed 40,000 more units of paper overnight. It didn't take a week, it didn't take a year. It was pretty much overnight. Money, the value of this paper currency lost 60% of its value. And so when you went to go buy things at the store, like bread, prices were 60% higher if you were paying with this paper money. And so there's a really important lesson here, and that is creating more money, printing more money is not creating more wealth. You are not making people wealthier. You're not creating more wealth in the world when you create more units of currency. And so it was a really interesting, I guess, lesson that we never really learned, and we're still trying to learn that today. And so if you look at the history of our paper money over time, we've seen a lot of them fail, and there's a good reason why. And so when we start looking at policies that we have today, we see that there are very specific goals that central banks have when managing money. And those goals are, and this varies from country to country, and it's central bank to central bank, but they tend to be very similar. And the big one is creating a sound financial system. So that's a really key objective, because you want certainty. Without certainty, businesses can't thrive. If a business doesn't know what the value of a currency is tomorrow, then they can't make judgment calls, and they can't operate their business effectively with a lot more unknowns that they have to deal with. Another key objective that central banks have is low unemployment. They don't want a lot of people unemployed. There are a lot of negative consequences that come from unemployment. For example, higher crime. I guess that's really a big one, but also not really producing more value. If people are unemployed, they're not doing anything. They're not helping themselves. They're not helping other people. And so that's a key goal for a lot of central banks. And then lastly, price stability. And that kind of goes back to the sound financial system. So with price stability, you have certainty, which gives businesses confidence to make decisions, both small and big, around things like hiring, investing, growing, selling. And so price stability is really important. But when we look at the reality, when a central bank comes into play, oftentimes the opposite happens. And a big reason why is because the currency that we use today is no longer sound. It's been detached from its from being bound by the laws of physics. And so in the late 1600s, we had an experiment with paper money, and it failed. There was essentially, in Massachusetts, over a few weeks, the value of the currency lost 100% of its value. So we didn't really go into too much paper money until a few hundred years later. But in the 1700s and 1800s, there were some very interesting innovations, and people started to accumulate more wealth. So people started accumulating gold and silver, and they started storing them in warehouses. This is where the first banks come from. The first bank was actually called a warehouse. And of course, we see that banking came from northern Italy, places like Florence and Venice, where blacksmiths would preserve or hold onto people's coinage. And so you would go and take your gold and silver to a blacksmith, and they would give you a paper receipt that allowed you to redeem the gold or silver at a future date. As migration occurred to the Americas, what we started to see was competition of money. And with the ability to have paper money, banks within the Americas started issuing their own currencies. So each bank would have their own currency, and you would deposit gold and silver in the bank. The bank would give you a piece of paper that was essentially a receipt for that gold and silver, but that piece of paper also became essentially a form of money. And so when you went to the store, you could redeem, or you could give the merchant a piece of paper that had the bank stamp on it. And that piece of paper essentially de facto became currency. And so in the 1800s, lots of different banks, hundreds, thousands, tens of thousands of banks had their own currencies within the Americas. And so what we noticed was that banks that were issuing a lot more paper than what they had in reserves in gold and silver were the banks that went bust. Now, when a bank went bankrupt, it would impact that local community. It would really harm the town, the city, the local jurisdiction that the bank resided in. However, the impact was very minimal. The impact was not widespread, and oftentimes the community would bounce back very quickly. So what happened in the 1900s was essentially an aggregation of the banks. And so the banks essentially used clearinghouses, and those clearinghouses were removed in favor of a central bank. And the central bank essentially became the decider of the currency in that local jurisdiction. And so when we look at a central bank, we see that they attempt to control the money supply. And it's a very interesting history, but basically in 1930, so there were a number of central banks that were forming in the 1800s in Europe, and they put a lot of pressure on the Americas, and a central bank in the United States formed in 1913. And in the late 1920s and starting in the early 1930s, there were mandates that required people to turn in their gold and silver for paper. So in 1933, gold became illegal to own in the United States. And the reason why I talk about the US here in New Zealand is the monetary system that we have today is very heavily impacted by the United States dollar. 85% of world trade is in US dollars. And most or a lot of currencies in the world are still pegged to the US dollar. And a big reason why was after World War II, essentially what happened was an agreement where all the countries in the world decided to peg their currency to the dollar, the US dollar, and the US dollar, or the US government agreed that the US dollar would be pegged to silver and gold. Now, this was what I would say a big mistake. The countries in the world should have pegged their currencies to gold and silver rather than the US dollar. Because what did the US promise? They promised that they would never change the currency conversion from US dollars to gold and silver. But and at the time, you could essentially redeem 1 silver dollar for 1 US dollar, roughly. You could redeem 35 US dollars for 1 ounce of gold. So it's essentially pegged at a very specific conversion. And so there was a lot of certainty in the world. You could always convert 35 US dollars for exactly 1 ounce of gold. Now, in the 1950s and the 1960s, the US started cheating. Rather than maintaining that peg of $35 to 1 ounce of gold, the US started funding a lot of projects, specifically wars in Vietnam and Korea. And to fund this, the US government had to print paper money. And so the US government was printing more and more paper money and couldn't back that with gold and silver. So they had more paper than what they had in gold and silver. And in 1971, the French government, which had a lot of US dollars, a lot of paper, because essentially how the paper gets created is through debt. So the US Treasury or the US government wants to fund something. To fund something, they need to print more paper. And so they essentially have to have an IOU. They create an IOU, and essentially the US Treasury sells that IOU for dollars. The Federal Reserve prints the dollars to buy the IOU from the Treasury, and now there's new paper in the world. But not always, the central bank buys the IOUs. It's also banks, private citizens, and other countries. So other countries were buying the debt from the US government. And in 1971, the French government wanted to redeem their US dollars for gold, because that was what was expected, that you could convert $35 for 1 ounce of gold. And so when the French government went to do that, the US decided to refuse that request. And so within days, the price started moving. So for about 40 years, the US dollar maintained its value of 35 pieces of paper for 1 ounce of gold. And in 1971, in August 1971, so it's been exactly 50 years, that peg started moving. This started creating a lot of turmoil in the industry, and gold essentially went from, over the next 10 years, from $35 an ounce to $800 an ounce. And that was primarily because more and more paper dollars were being printed against a very small quantity of gold. And so when we look at inflation, we are usually given a textbook definition. And that textbook definition is that inflation is an increase in prices. But we really have a backwards definition of inflation, because inflation is, or an increase in prices is a consequence of inflation, not the cause of inflation. So inflation is an increase in the money supply. So that is printing more paper. And by printing more paper, what we see as a consequence is that prices rise, prices go up. And so we have a moral hazard. And the moral hazard is monetary policy and fiscal policy. So we've given our control over monetary and policy to essentially the same entity. And so when we look at fiscal policy is about balancing the budget. The government is given a responsibility to utilize the money that we give. We give it. So, they're meant to be the stewards of the money that it receives to service the people. And so, the government gets a lot of its money through taxation. And fiscal policy is about balancing the budget, taking in a finite amount of resources, taking in tax revenue, and utilizing that tax revenue to service the people in the most effective way, whether that's infrastructure, roads, protecting property rights. It's really up to the people in the jurisdiction to identify what the needs of the people are. And so the purpose of the government is to manage this money in the best possible way. However, if the government wants to spend more money than it has, for example, it's spent all its money on education and roads, but now it needs money for security or for more welfare programs or different projects, then the government can now turn to a new form of acquiring money to pay for those projects. And that is when it turns to monetary policy. So the government can't pay for everything it wants to through its tax revenue. And it wants to spend more. And so what it can now do is create more paper money to spend that money on different projects. So they contradict each other, because rather than balancing the budget, now the government has the ability to create more money on the side to pay for things. Now, this is a hidden tax. And the reason why it's a hidden tax is because a lot of people don't even realize that this is happening. Rather than asking permission to increase tax rates to spend money on a project, what the government can now do is print more money, essentially without our permission, to pay for the projects. And so what that results in is more paper in the economy. With more paper in the economy, as we go back to what I said before, we're not creating more wealth. We just have more paper. And so this creates some unintended consequences. And a big reason why is something called the Austrian business cycle. So instead of letting market dictate the price of money, we have put the control over the monetary system to central planners, and specifically the central bank. And what they attempt to do is collect information on the economy. And so they attempt to collect data, as much data as they can, to understand how the health of the economy and to make decisions. Specifically, they attempt to target a specific interest rate or what the price of money should be. But rather than letting the market decide what the price of money should be, well, the central bank attempts to decide what the price of money is themselves. So this is where we go to central planning. And so because they don't have the ability to collect all the information of time and place, they essentially have pretty good picture of the economy, but they don't have the full picture. And so they cannot set the interest rates to what the market is, but they can set the interest rates to what close to the market is based on the data that they have. And so the central bank targets a specific interest rate, and that interest rate might be higher or lower than what the market interest rate is. And so oftentimes we see, at least currently, we see that central banks around the world are setting extremely low interest rates, at zero, negative, below zero, or very close to zero. And so when you set an interest rate really low, what you're essentially doing is signaling to the market that it's okay to borrow money. The economy is healthy, so it's okay to borrow money. And so a business that wants to invest in a new project, a warehouse, in capital, they do an analysis and they base decisions on the current interest rate that it's okay to borrow money and invest in this project to receive this return and grow the business. However, if the central bank sets the interest rate below what the market interest rate should be, then what they're essentially doing is sending false signals to the market. And so with these false signals, businesses are borrowing money when they shouldn't be, because the interest rates are lower than what the market interest rate is. And so what this ends up doing is something called malinvestment or misallocation of resources. The interest rate's lower than what it should be. Businesses are borrowing money based on these signals. And when the market corrects, we realize that the business overinvested in money. The business miscalculated what the return is and based on incorrect signals, and therefore the business cannot repay those loans. And this is creates a cycle of booms and busts. So when we look at the 1800s, when banks were issuing their own currencies, and some of the banks cheated and caused a local bust, we could see that it was very isolated. But when we start doing this at a national level, this starts impacting millions of people and millions of businesses. And so when we look at an interest rate in a country as large as the US, we see that the central bank attempts to set the interest rate across at the same across the entire country. Now, businesses in California are very different than businesses in New York. The environments are very different. And so the interest rates should really be quite different between businesses in Silicon Valley and businesses in New York. But with a one entity dictating the interest rates or the OTC rate across the entire country, it's the same rate in California as it is in New York. And so it's either too high somewhere or too low somewhere else. We can see this in happening in real world, in the last 10 years. And a great example is looking at Europe. We have the ECB setting the interest rates for all the countries in Europe, and the interest rates are either too low or too high. And so we see an interest rate that might be great for a company or a country like Germany, but terrible for a country like Greece. And this causes really big unintended consequences when we have central planning that's essentially relying on entities trying to dictate the prices of money rather than the market try and dictate the price of money. And so an unintended consequence is that inflation encourages consumption rather than savings. So if you have a job, a salary, and a couple hundred years ago, your salary was in silver, the silver that you brought in today would be worth more tomorrow and would be worth more in 100 or next year. And so you as an individual have an incentive to preserve your wealth and save. And this is why 100 years ago, we had much higher savings rates. So savings rates were around 12 to 14%. Whereas today, our saving rates are abysmal. They're near zero, and in some cases, they're negative. And the reason why is if you make $100 today and you get that $100 in your bank, a year from now, that $100 is worth $97. And so because the dollars that you have in the bank are worth less and less each year, you now have an incentive to spend your money. But what's worse today is that we have an incentive, because money is so cheap, to not only spend the money that we currently have, but borrow future money and spend that today. And so we have a huge debt problem that's been brewing over the last 20 years. And the reason why is the incentivization in our monetary system incentivizes us to spend more money than save. And when we look at a healthy, growing economy, what we see is accumulation of savings, accumulation of capital, and the preservation of that capital is what grows an economy. Because by accumulating capital, you essentially enable production of goods to be cheaper. And so things should become cheaper over time. You accumulate a big factory that can make batteries more efficient. And so the cost of batteries should go down over time. You make a factory that's more efficient in making chocolate. The cost of making chocolate, the cost of chocolate should go down over time. And that used to be the case until we transitioned away from sound money and towards paper money. So now with a system of paper money, everything goes up in price, but there's no reason why it should. And a big reason why is we're incentivized to consume and waste rather than preserve and save. This misallocation, as I've said before, essentially incentivizes or encourages the accumulation of debt and spending rather than the preservation and accumulation of wealth. And so when we look at our current monetary system, we see that paper money has a life expectancy of about 27 years, and almost all of them have lost 99% of value or more. Now, if we look at the longest running paper currency, it would be the British pound. It's been around for several hundred years. However, over at the time, a British pound was 12 ounces of silver, and now it can only buy 0.5% of that original value. So the British pound has lost 99.5% of its value since transitioning to a paper currency. And so we haven't really had innovation in money over the last 100 years. And a big reason why is because of the legal tender. Legal tender is essentially a requirement by law that a certain type of money is essentially the currency of the land. It's currency by decree. And so we've been in the physical realm, and within the physical realm, we haven't been able to innovate and create new forms of money because of laws that prevent competition and prevent the ability to utilize or experiment or try new forms of money. And so since the invention of Bitcoin, we now have the ability to compete and experiment and innovate with new forms of money. And a big reason why is that cryptocurrencies cannot be banned. It's very similar, like attempting to ban the internet. Now, for something like Bitcoin to be money, it must first become a commodity. It must first become universally acceptable and accepted. And we're not there yet. However, I do believe that we are in a paradigm shift where we are trying to find the next form of money. And so right now we are looking at these networks, these very big, very large trillion-dollar networks, blockchain networks, as experiments. And they are in the process of evolving into a commodity. Once one of these blockchains evolves into a commodity, it will have the ability to become a form of money that we use. And the interesting thing is that these currencies, or these digital tokens, if you will, are bound by the laws of physics. So they're not something that we can print or create through whim. We know exactly what the supply is. We can't cheat and print a little bit on the side to pay for things that we want to pay for. And so over the long run, people will have an incentive to preserve their wealth in different, they'll have not just an incentive, but choice to preserve their wealth in a variety of different options. And I think that people will tend to preserve their wealth in something that maintains more value year after year, rather than lose its value year after year. And this is why I think maybe it's Bitcoin, maybe it's something else. It's really up to the market, but we're in a really exciting time because we have the ability to have a better form of money over the next 50 years. And with a better form of money, we have a lot more certainty and a lot, we can give businesses the ability to make decisions that don't have to rely on uncertainty. And that means that they are able to carry on doing what they do best without having to worry about more external factors. And so I think this evolution of money that we are currently experiencing will create more human flourishing than we've ever experienced in humanity. And that's where I think that's where the excitement in crypto comes from. So I want to leave it there and open it up to questions.
Thank you. Again, just a reminder for our viewers, please just drop in a question in the Q&A box or in the chat as well, and we'll make sure that we ask it to Stephen. We do have a question, Stephen. Do you think Bitcoin is the natural next step or progression for currency?
So I think it has the potential. I think it has some good things going for it and some bad things going for it. So, when we look at cryptocurrencies, there's not really much competition with Bitcoin. We say that there's all these cryptocurrencies. Really, there's only a handful. And if we really want to narrow it down, maybe we can put it on one hand. And I don't want to speculate which ones they are, but there are things like Bitcoin, Litecoin, Dogecoin, Monero. I bring up Monero because that's something that Bitcoin is missing. Bitcoin is not fungible. And fungible, when we look at paper money, a dollar is a dollar is a dollar. So I give you $1, you give me $1. Even though they're different pieces of paper, they're always the exact same. Bitcoin's not exactly fungible because it has a history. Newly minted coins might hold a premium from coins that have been associated with dark market or illicit transactions.
True.
But when we look at a currency like Monero, it is a privacy coin. And so one Monero is always equal to one other Monero because we don't know what its history is. And so it's a lot more fungible. The other area of concerning thing of Bitcoin is its scalability. We're still trying to work that out. We have layer 2s And we just don't know what the new technologies are going to bring. In 2011, when I first, laughed at Bitcoin for a year because it was intangible, I didn't, was thinking, at the time I was thinking that for us to have sound money, we need to restore gold and silver as the form of money. I've realized that gold and silver will really never be returned, will really never be money again, because money is evolving and we have more needs or different needs now with the internet. And so, value can be subjective, and so this is where Bitcoin can have that value. But at the time when I sent Bitcoin, the transaction fee was zero. I could send somebody 1,000 Bitcoin, and when I sent somebody 1,000 Bitcoin, the fee was zero, or it was like a fraction of a cent, a thousandth of a cent. And so that was amazing. That was mind-boggling. I could send somebody $10 million in Bitcoin and a fraction of a cent. I could send somebody 30 cents in Bitcoin and it would be a fraction of a cent. And that was amazing. But today, it costs a few dollars to send Bitcoin. And so it definitely has some of the proper potential properties to be money. It could be a medium of exchange. It has the ability to, and it's actually really medium of exchange. There's so much packed in there. It's a universally accepted medium of exchange. That's really what it means. And so it's not really a medium of exchange yet because it's not universally accepted. It is a unit of account, or can be argued it's a unit of account. It can be argued that it's a better storage of wealth than the dollar. The last 10 years, the New Zealand dollar has lost 50% of its value. Each year, the New Zealand government prints 3% more paper. And so, you compound that over 10 years, that's about 45% of the New Zealand dollar has lost about 45% of its value. But so Bitcoin has done an exceptional job of storing value, but it has some issues, and those issues need to be resolved for it to become a good form of money. But when we look at contenders, it doesn't really have a lot of competition right now.
When you mentioned about gold and storage of wealth, what do you think about the idea that Bitcoin is an ex-gold and ETH is an ex-silver in direct comparison?
I think I don't think it's a good comparison. So apples and oranges. Ethereum, the Ethereum protocol, they're doing all kinds of weird things over there, and so Vitalik, he has a relatively good understanding of money and economics, but a lot of the people behind the Ethereum project are engineers, software engineers. They don't really have any concept or understanding of money, and it's essentially trying to be central banks for currencies. They're trying to engineer it top down and plan it. And so, they're coming up with these wild ideas, which I don't have anything against. They're experimenting, they're trying things. Go for it. We want more innovation, we want more competition. But the thing is they're throwing out really strange ideas like an infinite supply, a supply that never ends. And the purpose of Ethereum is really, the token's meant to be gas to execute an application. And I don't know where Ethereum will end, but it's going in a very different direction of what good use of money will be. But who knows? It's establishing that utility. And so yeah, we'll see. In terms of Bitcoin as gold, I think it's looking like it's more a form of gold in its present form rather than gold in its older form. In its older form, gold was money. Gold wasn't something that you hoard and put somewhere else. It's something that you use in circulation, that you pay your staff on a daily basis, you have in your pocket, you give somebody to pay for a loaf of bread. It was currency.
Mm.
And, and so it's not that anymore. I wouldn't say gold is money anymore. And in that same light, I'd say Bitcoin probably is gold today, or similar, more similar to gold today, in that it's not currency. It is kind of seen as the storage or hedge or reserve. Yeah, I'll leave it at that.
Cool. One direct question from our attendee. Volatility of Bitcoin is an issue, right? Why would I want to be paid in Bitcoin when it's so up and down?
Great question. So I've been getting paid in Bitcoin for 8 years now, and I got rid of my bank account about 2 years ago, and I have really the opposite question. Why would I ever want to receive dollars, today, when it loses, it's guaranteed to lose its value year after year. But I guess it really depends on how you manage it. So, for example, I use a Bitcoin Visa card, so I receive my salary in Bitcoin to my Visa card, and I might convert some of it to a national currency. So, have my expenses sorted for the next 2 weeks at a specific or guaranteed rate. But I think that, if you're looking at crypto or Bitcoin over the long term, where it has the potential of being a better form of money, then I don't see why you wouldn't want to receive a portion of your income in money or in Bitcoin. And because, as Bitcoin stabilizes, it's a lot more guaranteed that it's going to retain its value year after year, as opposed to the dollar. Over the last 10 years, 100% of the time, the New Zealand dollar has lost its value. So, so every single year over the last 10 years, the New Zealand dollar has lost its value. But over the last 10 years, Bitcoin has only lost its value once in the course of the year. And so, when you start looking at its track record, Bitcoin has held up better than pretty much any other paper currency in the world ever. And although it's still so new, it's only 10 years, it's basically lasted only a third of what all other current paper currencies have lasted for. It's doing pretty good. So, let's wait another 17 years and see how Bitcoin performs. And, in another 17 years, Bitcoin's still around, if it's still doing what it's been doing over the last 10 years, then you can look at Bitcoin as a better form of money than any other paper currency in the average paper currency that's existed.
Perfect. Thank you for that. And last question, any thoughts on El Salvador?
Yeah, I think what they're doing is great. We wrote a piece about it. We wrote a blog post about it.
Yeah.
I think we're going to see between 4 and 6 more countries adopt Bitcoin as legal tender over the next year. So I do think we're going to see, probably a 400% increase in that happening. The only thing that I did not like about what El Salvador is doing is making it mandatory for businesses and individuals to accept Bitcoin as a form of money in the country. I think by trying to make it forceful, you have to accept Bitcoin, you start causing problems. I think it should be optional based on the 2 parties that are present. You shouldn't force people to accept Bitcoin if they don't want to. So that's really the only big critique of the legislation that El Salvador passed. But other than that, I think they're doing really well. Something like 25% of Salvadorians are now using Bitcoin wallets on a regular basis. And so that enables Kiwis to now trade with 25% of people in this country that we were never able to trade with before. So good opportunities.
And also, if you want to read a little bit more about the blog that Stephen mentioned, it's called A Brief Review of El Salvador Bitcoin Law. You can find it at our blog.dassetx.com.
Yes.
And that's all we have for you today. Thank you so much for everyone that has joined us for this crypto talk. We do appreciate you tuning in and hope you learned a little bit more about the history of money and why Bitcoin. Also, if you're interested in a topic for us to cover of one of these awesome lunch sessions, please let us know. Drop us a message in any of our socials or directly contact our support team at support@dassetx.com. And before we sign up, any last words, Stephen?
I really appreciate everyone attending. And if there are any topics that you'd like to hear about, please let us know. We are going to have an accountant come and speak about the tax rulings and tax liability around crypto, specifically to New Zealand. Not in the next session, but that will be coming up pretty soon. So we're looking forward to sharing that one. And we'll talk to you soon.
See you.